Over the next month, volatility is probably going to be a lot higher than normal. The reason being is because Trump is a relatively new face to the political scene. The markets can process good news and the markets can process bad news, but what the market hates more than anything else is uncertainty. And with a Trump election, there's a lot of uncertainty because you're not sure what political actions his presidency is going to entail. However, looking past this period of volatility, we're going to be looking at that as a good buying opportunity to pick up stocks that temporarily went on sale. One area where you could see pronounced selling are multinationals. Both candidates have courted the blue-collar manufacturing worker, but Trump has done so much more consistently. He's talked about renegotiating NAFTA. He called China a currency manipulator, and he's also proposed to build a wall across the Mexican border. So large and mega-cap companies are going to be the ones that bear the brunt of this selling. If you do start to see trade retaliation, that's why you're going to see that sell-off actually materialize. So Trump has talked about putting trade tariffs on goods coming into the U.S., and if that happens, the other countries will respond by placing tariffs on goods going out of the U.S. Smaller cap companies could be a place to put some money from a relative value perspective. Most of these companies are domestically oriented, and they're going to be fairly insulated from a global trade war. Trump has consistently supported the American shale revolution. He wants to remove some of the onerous legislation that's out there, and he also wants to unlock the productive possibilities that the U.S. energy sector can bring to the table. So with Trump and what his administration could possibly bring, we think that that's going to increase the productive capability of the U.S. by about 500,000 barrels per day. So that's going to put a little bit of pressure on oil prices globally, because you're going to need demand to overcome this additional supply coming onto the market, but it's going to be great for U.S. operators longer term. Also, about 20 to 25% of all oil and gas activity occurs on federal lands and water. So because Trump and the Republicans are supportive of the energy revolution, they're going to still have access to that land and could potentially expand on what they currently are producing there. Healthcare, specifically biotech, pharma, managed care, and PBMs stand to be the biggest beneficiaries of this new administration. Under a Trump presidency, you're going to see drug price increases slow versus the torrid pace they had a couple of years ago because of the scrutiny from both a media and a political standpoint, but nonetheless, the greatest fear of legislation regulating drug prices won't come to fruition. Also, you could see a possible repeal of the ACA or Obamacare, which would be great for managed care companies. If you look at healthcare, valuations are pricing in the worst case scenario, so we think looking into 2017 that a lot of these names are going to be melting up as the year evolves. A Trump presidency would most likely be bullish for the financial sector longer term. Although most Republicans would like to repeal Dodd-Frank, it's most likely not going to happen, but they can change some things on the margin and water down some potential regulations coming into place. Both Republicans and Democrats have talked about raising the threshold for a financial institution to be systematically important. Right now it's currently at $50 billion. They're going to propose to raise that to $250 billion. And what that's going to do, it's going to unlock a lot of these regional banks from that legislation. So these banks can potentially grow faster by increasing their loan books, but they can also engage in shareholder-friendly activities. Yeah, the U.S. is desperately in need of an infrastructure upgrade, and I think we may actually get it over the next decade. Trump has campaigned and talked about spending $1 trillion on infrastructure over the next 10 years. This is going to be really good for infrastructure companies, but you may see a delayed effect. This still has to go to Congress and be passed, and you're not going to see that money make it into the economy until 2018. So you may have a better vantage point for these companies looking out a couple months. So Trump has proposed to cut taxes for both individuals and businesses by a wide margin. It models the plan that the Republicans came out with earlier this year, so it does have a realistic shot of passing. So he's going to cut individual tax rates down to 12, 25, and 33%. That's going to put a lot of money in people's pockets, and since the U.S. is a consumer-led economy, More money in people's pockets equals more money in the economy and higher economic growth. You're also going to see business taxes come down from 35% down to 15%. That's going to make the U.S. a much friendlier environment to operate in, and you could see a lot of companies move their operations back home, creating jobs, also good for the economy. But his tax plan cuts two ways. When you cut taxes to that degree, you're going to see a much bigger hole in our deficit. Conservative estimates have that at $4 to $5 trillion over the next 10 years. So you're likely going to see some pressure on the dollar, but you're also going to see some pressure on U.S. Treasury yields as well. On top of that, we've just exited our profit recession. You have M&A activity picking up. You have a healthy labor market, and you have a consumer that's in a position to spend. So we think going into 2017, the path of least resistance is up.